So, I mean, a very quick introduction to myself for those of you on the seminar that don't know me. So, my name's Dom. I'm a qualified accountant. I've been with Goodwille for about 3 years, and I look after the team that deliver our finance services. So, anything from our bookkeeping, so bank reconciliation, bank administration, all the way through to sort of financial statements, VAT, and tax support, sort of falls under my remit. Brilliant. Thanks, Nancy. Next slide. Okay, and a little bit about Goodwille before we properly start as well. So apologies for the clients on the call that know all this already, but as a quick refresher, and for anyone that is sort of looking to join Goodwille, we have 25 years experience of basically setting up, helping companies set up, grow and scale in the UK. So we do that over 5 departments. So we have a corporate governance team. These guys look after our company secretarial duties, any risk and compliance that our clients need. We have a HR team. So think of that as the life cycle of an employee. So anything from benchmarking, salaries and benefits for hires in the UK, contracts of employment and staff policies, staff handbooks, all the way through to if we need to make a redundancy or go through a disciplinary process. Those services are covered by our HR team. Our third department is payroll. So if you do make a hire, our payroll team look after the administration around submissions to the tax authorities and the net pay calculations for the staff, as well as any pension administration. Our fourth department is a virtual office. So this team typically looks after the trading address. So if you need to use our address for suppliers or customers, but also a telephone answering service. But this can be quite a bespoke service. So this team does deal with any ad hoc queries from our clients. And then last but not least, our finance team. So that's the team I look after, which I obviously covered a moment ago, but pretty much anything from daily transactional activities for finance through to more advisory on VAT, year-end and audit support. Thanks, Nancy. So the agenda for today, we're going to look at what is credit control and why is it important, and set the scene a little bit. Look at the steps involved in a credit control process and where we can advise a little bit there. Look at some softwares out there and how they can help automate the process and take some of the sort of the pain away and the manual process. Any statutory options. So this is more the formal legal approach of chasing debt. Any VAT considerations as well as some other financial impacts. And then finally wrap things up with some tips that we found are quite useful for our clients. Okay, so what is credit control? So it might sound quite obvious, this one, but a common misconception is that credit control just focuses on chasing the debt, whereas in reality, it covers the process from onboarding a customer right the way through to collecting that cash. So a key step that's missed out in credit control processes is that first onboarding of a customer and sort of determining their credit worthiness. So asking the question, will they pay you on time? And then, of course, it refers to the actual cash collection itself. So that's all the way from issuing an invoice, chasing that debt and getting it into the bank account. It's important for a couple of key reasons. Again, these might sound quite obvious, but it's all about the company's cash flow, firstly. So you can get some consistency around the cash flow. That obviously helps you pay your suppliers on time as a business, but also protecting the profits of that business. If credit control was to end up with a bad debt and a customer that couldn't pay and you had to write that debt off, that's going to be a cost to the business and obviously reduce the profit and have an impact there. So 2 key reasons why credit control is quite key for a business. Okay, so setting up a process. So firstly, you should look at who gets credit and who doesn't. So of course, credit is a privilege. You don't want to give away any hard-earned services, any goods that you make to customers that can't demonstrate they can pay on time. Good customers will be happy with this, so I wouldn't worry about losing customers over having credit terms and good credit control processes. It's typically the bad customers and the bad payers that have a problem with this, which is usually an indicator early that there might be an issue. So that's definitely a key step. Being accurate is also key. A lot of issues, I'd say this is probably the key area with credit control, where cash is late in being paid to you, is where invoices have mistakes on them. It might be the bank details aren't clear or not correct, and they might be addressed to the wrong entity. A key delay tactic we've found from our clients' customers is to ask for an invoice to be credited and reissued to a different entity. So having that chat up front and making sure the invoice is correct and accurate can save a lot of time down the line. Keeping records is also a key step. If things were to go down a legal route to chase the debt, you need to demonstrate everything you've done and sent to a customer, but also it helps with the next step 4, which is identifying trends. So once every couple of months, I guess sooner if you're a bigger business, you should analyze your accounts receivable ledger and the customer debt. That'll help you spot good customers that pay on time, customers that and customers that don't pay on time. And of course, if customers are falling into that latter category, and then that probably leads into step 5 there, having a plan for those bad payers. So having a plan ready saves some time. Time is of the essence, because the longer the debt sort of is overdue, the less likely it is to be paid. So having that plan is key. 6 is setting a timetable and sticking to that. So this is a timetable for the whole credit control process. It gives consistency, so it lets customers know what to expect, but also treats customers fairly, which is a key thing to demonstrate if it was to go down a legal process further down the line. That timetable can look something like, sending an invoice, following that up with maybe a supplier statement, which is step 7, maybe a more polite chaser letter, and then going again down the more formal routes if that hasn't yielded getting that cash in yet. So that leads us into step 7 there. I mentioned sending statements. This is something that is quite often missed. Typically, some clients of ours will send an invoice and then go straight into the sort of chasing by sending letters, whereas statements can be a very informal and polite way of reminding a customer what they owe. And we have seen quite a lot of issues get resolved with just sending this statement, as typically a customer may have forgotten to make the payment. Step 8 in the process is just asking yourself the question, can you do it all yourself? So of course, it's not the most exciting process and not the most value add in terms of generating growth in the business. Can you use softwares to automate the process? Can you outsource it? It's a service that Goodwille do offer. So if you are interested in that, you can speak to myself after this or your contact at Goodwille to learn some more how we can sort of implement it for you. But yeah, it's something that, is your time best focused on credit control, or can you make the process more efficient or outsource it? Number 9 is don't wait. So I mentioned this on having a plan for good players in step 5, but really it's not waiting and being efficient with the process. Like I said, the longer a debt remains overdue, the harder it is to collect. And then number 10, finally, is just reviewing your terms and reflecting the market. So that could be the UK market. So of course, if you're setting up in the UK for the first time, we can help advise what the typical culture is around payment terms, but also it's industry specific as well. So you want to make sure that you reflect that market, so your customers are more likely to pay on time and within credit terms if it's what they're expecting. Thanks, Nancy. So different softwares. So accounting systems is the first thing we wanted to talk about here. Most systems have a built-in process. They're very basic, but they are quite useful. So at Goodwille, we typically use Xero for a lot of our clients. We do use a couple of other softwares as well, but they can do things like send statements, send chaser, letters, and you can obviously bespoke the invoice templates. Like I said in the previous slide about making sure details are accurate and you have clear credit terms and bank details to use, we can make sure all of that looks okay. I think that bottom paragraph there is just talking about when you do use systems. Again, this might be a fairly obvious one, but we have seen this happen before. You can set rules to send statements and chasers to certain customers. Of course, you want to review those and make sure you review them regularly, so you're not chasing for debt where an agreement's been made or the debt's already been resolved, because that's just going to lead to customers getting annoyed. Thanks, Nancy. And then secondly, some specialist software. So of course, these will come at a greater cost than just the standard accounting system. At Goodwille, we actually use a system called Chaser, so we can recommend that. And if you'd like to find out more, then again, speak to your contact at Goodwille or myself after this, and we can give you some more information. But typically, these specialist softwares give you more MI data. They help you automate things better. So on the last slide, I talked about analysing the customer debt and making sure we do that regularly. Chaser does that for you. It gives you information, it gives you prompts, so it can help make things a lot more efficient and cost effective for the process. Thanks, Nancy. So looking at some statutory options. So of course, the easiest and cheapest option is to avoid this process. It's to have conversations with customers and go down a more softer route. But if that doesn't work, we do need to look at different options. So the first option is typically mediation. So you can apply for this through the UK government's website, and it's an impartial professional that gets both sides together to try and sort an agreement out. It's usually quick and cheaper than going to court, and it is confidential. If the debt's also less than £10,000, often this is offered free, so it can be quite a useful sort of route to go down. Second is making an official demand. So this is more of a last resort. So a statutory demand is what it's called, and that's where you tell the authorities in the UK that money is not being paid, and you can apply to the courts to make a sole practitioner bankrupt or a company liquidated. So obviously quite severe for the customer in terms of the consequences, and very high costs for you chasing the debt. So typically used less often, only for the very high debts. Of course, it would completely tarnish the relationship with the customer going down this approach. So that's why it will be last resort. I think because of the high costs involved, we definitely would encourage getting legal advice before doing this as well. Thanks, Nancy. So court action. So it's slightly less severe option than the official demand. This is where you just apply to the courts to start a process to recover the money. There is some cost involved. It's usually small. And if you win and the courts side on your favour, they will order the money to be repaid. So charging interest. So this is something you can do in the UK. If a customer owes you debt outside of your payment terms and the debt's become overdue, you can prorate the interest on a daily basis and charge them that. It's called statutory interest if it's not in a contract, which is 8% plus the Bank of England rate. If you do have a contract that states a different interest rate, that will supersede the 8%, and you must use the contractual interest rate. Again, it can tarnish the relationship with the customer to start charging interest, so use it with caution. But on the flip side of that, it can be a deterrent to make late payments. So it's something we do see used in the UK quite often. And then finally, on the statutory legal options, it's looking at what options you have if your customer goes bankrupt or into administration. So you have to register for your claim through the UK government. That will go to that person's liquidator, that business's liquidator, and you will effectively join a queue of liabilities that company owes. In the UK, there is a legal sort of preference of who gets paid. So, for example, employees would get paid out of a business first, but suppliers are usually next in line. And if you've registered this claim, if there is any money left in that business's bank, you will get a share of that relative to what debt is owed to you. Again, any of these options we can advise a bit further on, and we do have some partners that can support with the legal side of things as well, if we were to go down that approach. Thanks, Nancy. So this slide just talks about some VAT and financial considerations. So the bottom two bullet points there, we covered slightly earlier in the seminar. It's more about protecting profits. So if a debt does turn bad and irrecoverable, that will be a cost to the business and reduce the profits of that business, and also the cash flows. So the key thing there being watching out that you have cash to pay your suppliers if you're not getting the cash in from your customers and the sales you've made. But the top bullet point talks about VAT. So if you are VAT registered, you will pay VAT when a sales invoice is raised to the tax authorities. If the debt becomes irrecoverable, even if it's bankruptcy or liquidation, you do have to wait 6 months from the invoice date to recover that cash from the tax authorities. So that's one thing to be aware of, and making sure you don't fall foul of that 6-month rule. Of course, if we do your VAT returns for you and you're an existing client, we'll look after that and make sure we're within those timelines anyway. Thanks, Nancy. Okay, so final slide from me. It's just some six simple tips really and things we found really useful. So first off is checking your sales ledger regularly, keeping up to date as possible of what sales you're making. It can identify bad payers and flag problems early on. And obviously, if you're flagging problems early on, it avoids any bad debt buildup, any credit control backlogs, and it helps you keep on top of things. Second is prioritizing customer relationships. So again, sounds like a fairly obvious one, but definitely one of the most powerful tips on this slide. This works both ways. So having really open communications with your customers means that they're more likely to be transparent with you if they've got issues with paying or they've run into financial trouble and need a bit of flexibility. But likewise, if you've got that strong relationship, they're more likely to be accepting and also understand when you need to change your payment terms or maybe ask for upfront payments or part payments. So definitely focus on that customer relationship. It does form part of an effective credit control process. Number three is monitoring credit scores. So for new customers, this is definitely recommended. This is where you would use a credit reference agency. A typical one in the UK is someone called Dun & Bradstreet, but there are others. And that's where you can pay a subscription and look at the financial health of your customer or potential customer. This will give you a report back that tells you how sort of liquid they are, how likely they are to pay you, and do they have any financial troubles. And that can obviously mean, it doesn't necessarily mean you're not going to take them on as a customer. It just means you might change your payment terms bespokely to fit that customer. So you might ask for upfront payments to begin with, or have slightly stricter credit terms. As well as new customers, we definitely recommend you do this for existing customers as well. And this is often a part that is forgotten. Of course, existing customers' circumstances can change. They can fall into financial troubles, and it's probably normal culture for them not to shout about that straight away. But if you're looking at regular credit checks, you'll be able to spot that and act accordingly. Okay, so revisiting your invoice design, probably with number two, it's probably equally as important tip on this slide. And it goes back to being accurate. And when I spoke about being accurate earlier on in the seminar, if the invoice isn't clear, customers don't know how to pay, when to pay, or what bank to pay, it's going to lead to credit control issues and potentially give customers an easy excuse or delayed tactic for not paying. So if the invoice isn't clear or you're getting feedback from customers that it's not clear, then it's definitely worth having a look at that and making sure that that is easy to read and easy to communicate over on the invoice design. Goodwille do raise sales invoices for a lot of our clients. So if you want any help with that, we have templates that we can send over. Like I said, just let me know or your contact at Goodwille. Number five, this is a fairly obvious one, but worth mentioning, it's prioritizing bigger debts. If debts do fall overdue, of course, focus your attention on the ones that are larger, as typically the reasons for why they're not paying might be more obvious, and it's going to have a better impact on your cash flows if we get that cash in first. And then finally, step six is just taking appropriate action. So this will be determined on the size of the debt. Sometimes if the debt is very, very small, after a couple of polite chases and sending statements, you might make the decision it's cheaper for you as a business to write that debt off without further chasing. So that might be an option for very small debt. But typically you'll want to go through the softer route first, sending statements, polite chases, phone calls to keep that customer relationship transparent and open. I mean, often we see that works, and that gets the majority of overdue debt in. If that still doesn't work, going back to the previous slide in the seminar, we can look at the more statutory, legal, formal options through going through the courts, using mediation, and potentially charging interest to customers for overdue debt. Okay, that's probably it for me. So I'll just hand back to Nancy to see